Down round. Down rounds are when you go from a company that has a valuation of, say, $10 million, because everyone had a lot of hope and everything was going so well, to a lower post-money valuation in a subsequent round. So the price per share goes down in the subsequent round. And down rounds are considered a pretty bad thing, but in effect, if they're reflecting reality, that's kind of a good thing. What down rounds do, though, is they dilute the ownership of the company by a lot, because new shares coming in will be valued at less than the old shares, which kicks in a lot of anti-dilution privileges from previous shareholders, and also ratchets from previous shareholders, so that if future investors come in with lower prices per shares, that more shares are created for preferred share owners. So there's a lot of concern about down rounds. When you do out the cap tables, pre and post down round, you find exactly how much of a concern it really is. But down rounds are necessary where there are a lot of management team changes, or where there's a lot of dead weight on the cap table. You can look up cap table elsewhere. But if there's a lot of non-working members of a cap table that are not contributing to the business, that is one of the reasons why down rounds will take place, is to flush out some of the ownership of founders that left the business, even though the business isn't profitable, but still own like a majority of the shares of the interest in the company. A lot of times when a major event like that happens, it'll force a down round, and the company will have to be recapped. Recap meaning the cap table is completely redone using financial engineering. So down round are generally considered a bad thing, but it's reality. Down round.
VC Lingo. Lingo.